Now, Kathryn Rooney Vera, friend of the program, head of global macro and chief investment strategist over at Baltic Capital Markets, which has roughly $2 billion in assets under management. Kathryn, always lovely to see you, even on a day like today where I think we're all kind of stressing not only over the humanitarian crisis overseas, the military crisis, but of course the market effects here. And I want to talk a little bit here about how you position yourself in a market like this where the known unknowns are back to being unknown once again.
Right. Sure, that's a good way to say it, Romaine. And once again, bad news is good news and good news is bad news. So the market has had a minimalist response to the Russian incursion onto Ukrainian soil, precisely because the market's retracing all of its previously, bearish exposure or expectation from a tightening Fed. So now, of course, the market is expecting 25 basis points in March. I do too. The Fed is going to have to continue to tamper down inflation, which is, I think, invariably going to get worse before it gets better. The way you position, Romaine, and this is what I've been talking about with our clients at Baltic, and I'll raise my hand and say I was ahead of the pack talking about stagflation. It was coming into this year. We said stagflation is the biggest risk this year, and I do think that's going to be the case. That's now our base case scenario, Romaine, which is at least a half a point detracted from U.S. GDP growth this year just because of a $25 price per barrel increase in Brent crude. That's our estimation in-house. We think that growth in the U.S. is going to slow below 3%, and that is the definition of stagflation. Growth running below potential with inflation still extraordinarily high.
What do you then do with bonds and the role that it's now supposed to play in your portfolio?
Well, kind of finishing the circle with regard to equities, we like utilities, was just kind of like a bond proxy because that is one of the sectors that historically, again, an analysis we've done in-house, historically has outperformed in a stagflationary environment. And within the equity space, that's energy, utilities, staples, and healthcare. Those are the sectors that we should be in if you're expecting a stagflationary scenario. The treasuries, I've heard you ask this question before, Taylor, and I think you're right tactically. It's a safe haven in the near term. But if we're right and the Fed continues to take rates higher and real rates go higher, then you have to be careful, jumping into fixed income. I do think the Fed is going to have to continue its course. We're at full employment. Friday, we get non-farm numbers. Wage gains are tremendous. We entered into this geopolitical crisis, Taylor, at a 7% inflation rate, 40-year highs on inflation. So the Fed is going to have to stay the course and take real rates higher. That to me says stay overweight equities, favor value over growth, and go a little bit more defensive within sector picks.
Let's go outside the world of the US right now, Kathryn, because I was at a great sort of New Voices event that we hosted at Bloomberg last night with an emerging market voice in particular. And she was telling me over at TD Securities that really where it's going to benefit right now in terms of emerging markets is Latin America, as people have to rotate out of Eastern Europe. Is that what you're seeing, that relative outperformance in certain countries like that?
I completely concur, and actually in a publication that we're about to get out now, I say exactly that. So within emerging markets, LATAM stands to benefit. There's always winners and losers, Caroline, in a situation such as this. Argentina is a big, one of the big three wheat exporters. So you have soy, you have wheat. Russia, Ukraine is 40% of the world's wheat exporters. So Argentina has a lot to gain. Brazil and Colombia do on the energy front. So I was already positive on Brazil. Add Colombia into the mix. I think Argentina has some market share to gain from this scenario. Of course, then you have the Mexicos and the other countries within Latin America that don't export commodities and don't fare as well. But historically, I think there are some opportunities to look at in a stagflationary environment within the emerging market space and specifically within Latin America.
And we know that there's still going to be a lot of volatility accompanied by all that. How do you ride that, Kathryn?
Oh, absolutely. And you have to have a position, and Romaine, we've been saying this as well, defensive position, hold a position in gold, have some dry powder and cash. This is going to be immensely volatile. I think the market is getting ahead of itself and saying, this is all going to either work out, either Russia takes over Ukraine or they leave and markets are going to go higher. The Fed's not going to hike rates. I think that's premature, and it's the best case scenario. It's a bumpy ride, gets offensive, buy some commodities, buy those defensive sectors that I mentioned, energy, staples, utilities, and healthcare, and start to ride this out. I do think we have to be careful with regard to Federal Reserve risk. They can't tighten too much too quickly, because then it could, take us from a sub 3% growth rate into recession. So that's where I think we need to focus our attention.
I'm going to steal a Caroline Hyde question. Where is the role of Bitcoin for you?
Oh.
Yeah. Well, I've talked about this on your show before. I think Bitcoin does have a role within the alternatives proportion of a diversified portfolio. And I think you want to be in alternatives that have a lesser, to some degree, correlation with overall markets. So I think it does have, albeit a small piece, a small portion, I do think that it's part of a diversified portfolio.
Kathryn Rooney Vera, always love having you. Thank you so much. Head of Global Macro and Chief Investment Strategist for Baltic Capital Markets. Stay well.